Welcome to the Food Startups Podcast.
Hey guys, welcome to the 43rd episode. Our last episode got more downloads than we've ever had, so the audience is growing. I've been getting emails from you guys. I'm really excited and I want to continue to grow. I think one of the most important things to our growth is not just the quality of the show content and the guests we bring on, but the type of content. I want to touch certain subjects that may not be talked about. Some of them may not be incredibly sexy, but really important. And you'll see this in next week's episode, finance, financial intelligence for entrepreneurs, getting some key metrics so you can really understand the health of your business. And just to give you a preview for next week's episode, our guest has gone to Fortune 500 companies and gone into their finance department, the CFOs, and has found even the top guys get some basic fundamental questions wrong. So I think it's a must listen for just about everybody. Also have someone in international franchising, or I should say someone who was in international franchising, bringing largest franchise in the world to South America. And we're going to go through his story. So anyone that's ever been interested in a franchise or wants to know how to bring something that's successful in one country into another, it's going to have a lot of interesting stories. And then to finish up April, we're going to have an episode with an exciting insect protein startup. You may have been exposed to the cricket flower. Take note that I think it was like 4/5 of people in the world, 80% are already including insects in your diet. The way the world is shaped up with methane gas and the cost of beef and the amount of land, etc., insect protein will be a reality. So I'm excited, and I think it's a great opportunity for people to learn about this emerging industry. Now, today we have a grain trader. We're talking a grain trader of the major ones like corn, wheat, soy. But you're going to find that there's a lot of fundamentals that can be applied to your business. Reverse integration, which we talked about in a prior episode. Let's just say you're at one point in the supply chain. Maybe you have your brand. Maybe you should start investing in the farmland or the equipment of your supplier, moving down the supply chain. So we'll talk about investing in farmland. We'll talk about the effect of global warming. Maybe there's some plays there. And also, I'd say even most important are the stress factors of making trades. While you may not be trading on the Chicago Commodities Exchange, you're going to make a lot of big decisions in your business. Elaine Kub is going to help us unmask and get some better insight. Well, guys, thanks so much, and I am going to bring her in now. Today we have Elaine Kub. She is the author of Mastering the Grain Markets, How Profits Are Really Made, a 360-degree look at all aspects of grain trading, which draws on her experience as a futures broker, market analyst, grain merchandiser, and farmer. Before earning an engineering degree at Nebraska, she got her MBA from UC San Diego. She grew up on a family farm in South Dakota where she's still active in grain and livestock production. Fill in some holes here. Can you walk us through your career to this point and how you got into kind of the fundamental trading of grains?
Yeah, it's funny because I did not go about it in a direct path, or I didn't know that that's where I was going to end up. I was doing engineering, and then when I was getting my MBA out in California, I was working at a hedge fund brokerage, and I really liked the math and the trading part of it. But some of these assets just seemed really, I don't know, esoteric, like bonds or even equities to some extent. It's just what is this actual number representing? But for commodities, that's a real tangible substance. And that really spoke to me. And then someone else, was asking about the farm that I grew up on. And it was just like a light bulb, that I could bring the trading and the agriculture together. I really love the idea of agriculture and the people that are in agriculture. So that's really how it came together. I was an analyst. I was a trader. When I started in the industry, I wished there was a book like this that existed, and there wasn't. Since I've always kind of wanted to write a book, and I was writing a column for the company that I was an analyst for, I thought, hey, I'm not a terrible writer. I should give this a try. I put it together, and it's, in my opinion, or folks tell me, it's a good overview of the industry.
Yeah, I really enjoyed your book. I wanted to mention to our listeners today, it's going to be at foodstartupspodcast.com/grains, GRAINS. While Elaine trades a lot of the very, very large commodities like corn, wheat, and soy, there's a lot of fundamentals that we can apply to a roasted chickpeas business, or you're working with chocolate. Related to that, Let's go into the fundamentals. And this is from your book. Grain trading is a very special and exciting variety of trading. But at its heart, it's not much different than trading rocks or baseball cards or used cars. Can you elaborate on this and compare those to the fundamentals of other types of commodities?
Yeah, I mean, I think what I was trying to get at there is just that fundamental mindset of trading. And the used car example was good because that's something that pretty much everybody can visualize. You need to find a price that's fair for you as a buyer or is as high as you can get if you are the seller. And you're using, whatever information you can glean about what have people paid for this asset in the past. Are they desperate to receive it now? Is this a scarce asset? So you're just trying to glean all this information and put it into a price that you present to your counterparty. So trading, that's what trading is for anything. And you bring up roasted chickpeas or chocolate, or even in the grains, the physical grain market, less than the futures market, which are just sort of benchmark financial assets. But if you're trading physical grain, each truckload has specific qualities. It has a moisture content or a damage content. And so there can be inefficiencies in the physical market that you can then, manipulate to your advantage as a trader. If you know that your customer will be able to take X amount of damage in the corn, you might be able to trade off that truckload in this location, whereas knowing a different customer's needs brings you a different price someplace else. So there is a lot of inefficiencies in the physical market, and that's trading. And trading is also the futures market, those benchmark financial assets. You're less talking about the physical quantities and the inefficiencies there. Perhaps now you're talking about the statistical inefficiencies, the arbitrage between prices that you would expect to statistically have one ratio, but today they're trading at an underpriced ratio. That's an opportunity for you to buy. So trading, I think, is always looking for these inefficiencies, trying to find a fair price for your counterparties. And that's true of any asset whatsoever.
Right. And my concept, I'm not an expert trader by any means, but my concept of trade, I think like short to mid-range trades, futures, maybe 6 to 12 months. Let's just take it back, right, to any type of commodity. Maybe it could be, like we talked about quinoa before the podcast, if you're working with quinoa or roasted chickpeas. What if you have this idea that demand in, let's say, 4 to 5 years is just going to be way higher than supply? And without even having to learn how to trade on the market and everything, like investing in farms, how could someone play to that if they think that the demand for some type of, let's just say, a superfood is going to be a lot higher in 4 to 5 years?
Yeah, you mentioned the key word there is investing. So a long time frame like that, it's more like investing than trading because until that demand really gets built up, then you're just going to perhaps be building your business. So you could still be trading this quinoa or the chickpeas just back to back, minimizing your risk and building your book of business, right? So that when the 4 years come up, you have the volume and the scale to really be a big player in the market. So that's investing in a business and building the business. So whatever losses or minimal gains you might make in the first 3 years could be looked at as an investment in the future. And certainly finding the farmers or the counterparties, the customers for that, that's the nitty gritty activities that you would take place so that when the market is hot, then you can start trading.
So I got two follow-up questions here. Investing in a farm, yeah, this is probably a pretty complicated topic. What do you look for? Like, what are some of the keys to if you find some land? Because I've found land, but I've never invested in land myself. If you're going to invest in some land, what type of diligence do you need to do? How do you protect your risk?
This was actually a challenge for me in the book to make it readable for both farmers and investors because farming and trading are really kind of two different activities, but they're related. But farming, your opportunity is to create value. You're creating a substance from soil and sun and water. In that sense, you're creating an arbitrage from soil and sun and water and seed into a marketable product, but you're creating value. You're a manufacturing process more than a trading process. But then once that product has been made, now you're trading it. So as far as how do you build up the inputs to create that manufacturing process, right? Your land, if you're a farmer, that's your plant, right? That's your manufacturing plant. So what you should be looking for is what are you capable? A farmer that's going to be growing physically doing his own tasks, he needs to think about, is this close enough? What is the fertility of the soil? But if you were like a global investor trying to find farmland somewhere, I mean, honestly, we should be thinking of long-term climate implications. But mostly you should be looking for a net present value of all of the income streams for the next 50 years. Don't just go throw a bunch of money at land unless you know that it's going to be able to be productive. Furthermore, you have a lot of counterparty risk if you're going to be relying on custom work or other farmers, to be physically doing the work for you. Do you know that they're knowledgeable enough, that they're going to be trustworthy enough to do that work for you, and what's it going to cost you? So it gets more complex if you're not doing the work yourself. If you're a farmland investor, it's a pretty straightforward process if you're buying the land next door to you and you're a farmer and you're going to go farm that land yourself, and you have a pretty good idea of what the region is like and what the market is like in that region.
So you got to have someone with a really good farming background, someone that you trust to help you assess that, because if you don't understand the soil and all that stuff, it's pretty tough. Another question, so I'm curious, I'm not an expert at this by any means. With global warming, is this something that commodities traders are starting to factor, or looking into weather patterns specifically related to global warming or climate change?
Well, they should be. It's an interesting industry. It's not like mining, for instance, where there's 5 or 10 gigantic mining companies, and so there's only 5 or 10 decision processes that need to be made that affect the overall direction that industry grows. Agriculture is thousands and thousands of individual small business owners each making these decisions. So we can see the industry moving in certain directions, perhaps influenced by climate change, but it's a matter of individual guys making this decision. For instance, I'm thinking of the southern plains of the United States, which have had drought here for like the past 4 or 5 years, and it looks like it's going to be another drought. And we've seen the cattle herd of the United States fall down to the smallest it's been since the 70s, certainly, probably since the 1940s. Yeah, that's certainly happening. You just have a trend of the overall industry moving away from some areas or towards others. I read somewhere, what made me think of it is that I have heard of hedge funds, for instance, that are investing in farmland, and I don't know that that's such a great investment property. I think it should be owned by people who are going to be using it themselves in their businesses. But I've heard that there are funds that are going up into Canada, for instance, to the prairies there, because yes, long term, the idea would be that you might have higher temperatures and longer growing seasons going farther north, and desertification farther south in the southern part of the United States. But gosh, it's really interesting to see, and it's really interesting to wonder for California in particular, to this space that your podcast really addresses, the food startups, the smaller specialty crops, the vegetables, the nuts, the things that are really only grown in California in the United States. This looks like it's going to be a make or break year, 2015.
You're saying because of the drought in California, like wine and almonds, right now it's pretty precarious, where they're a little bit worried about their output this year?
Yeah, absolutely. So if you were trading almonds specifically, for instance, if you're worried about this drought in California being a long-term symptom of climate change that would happen more frequently, now perhaps we should be looking at where else can we grow almonds. I don't know the answers to that, but yeah, you talk about the long-term time frames of where you can find some market inefficiencies and build your business to make some trading opportunities in the future. I think that looking at the land and the geography is a real part of it.
Land and geography, like what profession is that? Do I look for a meteorologist? Who's the best person to talk to when it comes to that?
A climatologist, but it's so far in the future. And I'm not an expert in climatology. Farmers in the past 50 years have become very good at watching the weather, right? We watch the weather to tell us when to plant or when to spray. Still, predicting long-term climate is a really hard thing. Let's say you had access to a climate prediction that you really believed in. The next person you'd want to talk to is an agronomist or a geologist who could find land and soil that would produce well given your climate assumptions.
You really want to be careful, like you said, because if a climatologist, maybe their guess is only a little bit better than the average person reading the weather.
Right.
Really. So that it's important not to overvalue that if it's still a really difficult industry with too many question marks. One thing that I got from your book, because friends that do like day trading, and I don't envy them. It's really, really difficult. I know, like, I have a gambling instinct. I know I don't have the discipline. Talk about stress, right? And you said that you believe that the best trader understands the commodity that they're trading, how it's grown and processed, instead of exclusive technical trading, but knowing, 3 or 4 key technical indicators, but then also understanding the industry. Can you tell us why and give us an example of why you have that stance?
Well, I'm pretty much more on the camp of no technical trading. I believe that the grain markets are efficient enough to be on a random walk. Schiller has made the case that markets have some patterns. Sometimes there can be bubbles and information cascades. So sometimes you've got human behavioral economics coming in there and making short-term wild patterns. Overall, trying to find a technical indicator to tell you when to buy or sell an asset is crazy. It's asinine. And I think that the small food startup space is a great example of that, because let's say you're trading cashews or almonds. There's no futures market there. You can't really draw a chart very effectively of what the price of almonds have been for the past 5 years. So you've got to rely on the supply and the demand and the predictions for, is there going to be scarcity or abundance of that crop? And that's true, in my opinion, of all grains, of corn and soybeans and wheat. You might be able to find local areas that have scarcity or abundance, and that will affect the basis in those areas. And that's the best trading opportunities, or the least risky, the best chances of getting a return without taking on undue risk, in my opinion, in the grain markets. And trading them as a financial asset, trading those futures contracts themselves, I think still, like I mentioned, I think that they're an efficient market. There's enough people participating in them that technical trading is not the way to go.
Great answer. Now, okay, so some follow-ups here. So local scarcity for the audience, Elaine, I'm going to try to define it, and correct me. It's more like, let's say you're in Texas and you notice that price of corn is overvalued, or people are paying a lot for corn, and you find a way from Iowa to bring in some corn at a good price, and in a couple months sell that corn in Texas and pick up the margin. Kind of like a local inefficiency in the market. Is that correct?
Yeah. And that's the really key piece that I'm sure everybody in this space understands, is the transportation, right? Your cost to get the good from where it comes from to where it's going. That's going to be a big major part of your final price.
Right, and you can get an edge, and like, it's not just obviously the price of the product. Sometimes the difference between it working and not working with these small superfoods, Elaine, is, can we get a maritime container, or if it's going to be an air shipment, it's just not going to work with the numbers, and that's the whole thing there. So is there a way to combine? Is there a way to find someone that's working with specialty coffee and combine our containers? It's funny, I'm actually thinking that right now, because I see an opportunity where I would actually need to combine a container. I want to give you an example, because there's a lot of government data. So I was thinking about this. Let's take cashews. If I can look at the amount of cashews imported to the United States, right, and look at the number and get a rough idea of the amount of sales, and then also find the average price of cashews and build a spreadsheet just by year. Number of tons imported, average price for the market. Very, very rough data like that is not a bad starting point when you're in a space that's not traded on the futures market.
Yeah, it's a great starting space. And it's the exact, I think that what you are doing with your maritime containers, or what a theoretical cashew trader would be doing in this example, is exactly the kinds of things that physical grain traders are doing in the big, gigantic ABCD grain companies. They do these exact fundamental tasks. So you get some sort of an anchor price. You go, you find a potential customer, you make them an offer. They might make a counter bid, and you establish what they might be willing to pay, or what from the front end, what someone might be willing to sell it for. You figure out your transportation piece, and if there's margin in it, the trade is made. If there's not, you've got to go back and do more work on this, or find a different opportunity, or get creative somehow. But the fundamental tasks of trading grain, just very basic commodity grain, are the same fundamental tasks as trading any specialty food.
So this is something that I think applies to all types of business and stress, because you know this better than anyone. You sign on and it's all online, right? You sign on to whatever trading software you use. If you don't protect yourself on an option, or even if you protect yourself to some extent an option, you could lose your shirt. You could really lose a ton of money. Elaine, you've been in it for a long time. I interpret that as you've found a good way to manage your emotional stress. And emotionally, how do you manage that? Because it's got to be a lot of ups and downs.
Yeah, I mean, it's a huge amount of anxiety, particularly if you're making a speculative trade. You're trading futures or options, and you're just betting, effectively making a gamble that the whole market is going to move one way or the other. Well, you really cannot predict that, and you really are doing nothing more than making a bet. Trading in the actual food space or the actual agriculture space generally tends to be hedged. You'd be using the futures and options as a hedge against physical production or future physical sales. So that should have less stress, right? You should feel that if the price of one market goes up, the other market will go down and your losses will cancel out. Yeah, that should be a more sedate, sort of business-like activity, but there is still stress in that too. There's counterparty risk. And I think that in the specialty food space where you do not have the opportunities to hedge, now, unless you're making back-to-back trades with very trusted counterparties that you know are not going to drop the ball or not pay you. Let's say you just own a bunch of cashews and you don't know if you're going to find somebody to buy them or buy them at a higher price than where you bought them. So there's stress in every single piece of this space, but the advice would be to understand how much risk you have and to not be making these risky speculative trades unless that's what you really want to be doing.
Gotcha. Another quote from your book, and you talked about this a little bit. You said, "I believe you should approach each grain trade as an expression of some underlying idea about the supply and demand of grain rather than as a theoretical tool for investing." You talked about that, how you kind of have to understand the industry. Just give me just one more example of an underlying idea about supply and demand with respect to, let's say, soy.
Yeah, okay. Great example would be late June, early July of 2012. It had started out being a year when people planted a lot of grain, lots of acreage, seemed like it was going to be okay. But now, in about that time frame, middle of the summer, it became very clear that the drought in the United States, which is the number one producer of soy, is quite severe. So now all of a sudden you've got a real fundamental idea that there would be less supply than anyone had ever anticipated. And no other country in the world going to come in and relieve that scarcity until 6 months down the road when South America might have an adequate crop. That's a real fundamental bullish idea, and that's an opportunity to go into the markets and make a speculative trade that I think would make some sense. But on the other hand, there's a lot of money that flows into the commodity futures markets that's just like, oh, I'd like to diversify my portfolio. Let's buy an index. Agriculture commodities. And agriculture commodities, as you are all very aware, don't behave like stocks. They don't just automatically go up as they become more productive. The price is always a reflection of supply and demand, and there's no reason for that price to go up more than the rate of inflation over a long time frame. So it's not a great long-term investment to just sit and be long exposed in the grain markets, but there may be shorter-term investments where you've got an idea that the supply and demand might change and prices might move in a more volatile fashion.
Gotcha. Okay. I want to touch this again because it's the Food Stars podcast. We work more with specialty foods about applying the philosophy of grain trading that you implement in Mastering the Grain Markets in your book, working with these smaller specialty foods that aren't so heavily traded. Can you leave us with any final tips?
Yeah, I think being creative, right, and understanding your value chain. The market opportunities from commodity grain, the low margin business, because it doesn't seem like there's a lot of creative things you can do with them. But the success comes when you find a new market, a new customer that you didn't know would buy sorghum. Milo, for instance. China's buying all kinds of Milo from the US. Milo was 2 years ago a pretty dead market that nobody really wanted to grow. Now it's completely hot because somebody thought of a creative new place to send that, a creative new place to blend your grain and send damaged grain to take very cheap grain and make it worth something. Opportunities like that are going to be true in every trading space. So if you can find a new creative path for your goods, that's, I think, a key to creating value in your trading space.
I love it. Okay, be creative and understand your value chain. Well, Elaine, listen, I want to thank you so much for coming onto this podcast. We're going to add all the links to Elaine's book and everything talked about on our website. And how can people get in touch with you?
Well, I direct folks to the website, masteringthegrainmarkets.com, and they can send me an email. Yeah, check out the book. And thank you very much, Matt, for this opportunity. You got a great podcast.
Hey guys, thanks so much for listening. And as always, if you have any questions or comments, find us online at foodstartupspodcast.com.